Hello, my name's Clive Thompson. I'm still in a foreign country. Can you guess which one it is? I'll give you a clue. It's a country of great philosophers. But today we're going to be talking about corporate actions. What are corporate actions in the stock market and how can you profit from them? But let me first give you a little bit more information about where I am, see how quickly you can guess it. I'll give you a few clues. Alexander the Great, the man who was told that if he could untie the Gordian knot, he'd become a great ruler, and he sliced through it with his sword. And then there were famous philosophers, people like Socrates, Plato, Aristotle, and Homer, who wrote the Iliad and Odyssey. And then there was the great mathematician, Pythagoras, who discovered the Pythagoras theorem. The square of the hypotenuse is equal to the sum of the square of the other two sides. And we had Hippocrates, who was the father of modern medicine, discovering that illnesses are caused by nature or natural causes rather than by evil spirits, as they previously thought. And we had Archimedes' principle. Archimedes leapt out of his bath shouting Eureka when he discovered that the amount of water displaced equaled the volume of the object you put into the water, which led him to help the king discover if his crown was made of gold, pure gold. And unfortunately for the goldsmith, it was not. I believe the goldsmith came to a rather unfortunate end as a result. And of course, there's a number of famous actresses and actors. The only one that's coming to mind is Nana Mouskouri. So you guessed it now, it's Greece. Back to corporate actions. So what is a corporate action? A corporate action is when a company issues you with a notice about something which is happening, which requires your decision. Now, 99.9% of these corporate actions don't actually require you to make a decision, and there's no particular advantage in doing so. For example, one of the most common corporate actions is the announcement of an annual general meeting, where you can, if you want to go, you can fill in a form and go along to the annual general meeting if you're a shareholder and vote for reappointing the directors and approving the accounts and things like that. 99.9% of people don't do that, but maybe the biggest shareholders do get involved in looking at it seriously. But there's no real advantage to you if you do attend one of these meetings. So that's a corporate action which has got no consequence. Another type of corporate action is the notice of dividend, where sometimes they give you the option of taking your dividend in cash or taking your dividend in shares. Now, that is an important corporate action where there may be an advantage in choosing one or the other. Now, it does depend on the country you live in and the tax laws of your country, but if you've got a dividend which is paid in cash, it might be subject to withholding taxes, whereas if you've got a dividend of the same value, which is paid in shares, it may not be subject to withholding tax. So for many private individuals or others, there may be an advantage in choosing the stock dividend. So you'll get if you have your shares held in custody by a bank or a broker, you'll probably get a notice from your bank or broker saying this is a corporate action, choose between, you can, if you take no action, in general, you'll get the dividend in cash, but if you wish to elect, you can elect to receive your dividend in shares. And it's worth looking at the terms of the election, but in general, it's worth thinking about it if you will have a tax advantage. Now, obviously there's two sides to this. There's the withholding tax which might or might not be deducted from the share dividend, and then the second advantage we look at is, or disadvantage, is whether the share dividend is going to be taxed in your country. And in many cases, in many countries, they like to tax your share dividend exactly as if you'd received a dividend in cash. So there's no strong advantage in taking the share dividend. But it depends where you are and how it works, and also maybe whether you need a dividend, because perhaps you'd be happier you don't need the cash, increasing your exposure to the company if it's doing well by receiving your dividend and reinvesting it back into shares. What other corporate actions might we receive? Well, one which is usually quite important but kind of unusual, it's very rare, is notice of a takeover. So there'll be an offer for shares from one company to buy the company which you hold, and you need to vote whether to accept the offer or not to accept the offer. Now, in the vast majority of cases, if it's a serious bid, the offer price will be higher than the current price of the shares, but it will be always conditional on the offeror receiving a certain number of shares. So they might want to get more than 50% of shares, or 60% of shares, or 90% of the shares, or whatever it is. So when you receive these corporate actions, you should usually consider whether you want to vote in favour of accepting the offer or refusing the offer. Actually, this is technically not a corporate action, it's an offer by another company. The corporate action is not action by the company itself. This is an offer by a third party. But when you get this offer letter from your bank or your broker saying, do you want to accept the offer? Well, if you accept it, you'll only get the cash which is on offer if enough shareholders also accept the offer, i.e. if they achieve the required percentage, 50, 60, 70%, whatever they want, 90%. But the disadvantage is if you accept the offer and enough other shareholders accept the offer, you're going to get the amount offered, whereas if not enough shareholders accept the offer, then at the end of the day, the offerer, the company which is making the offer, might decide to increase the size of its offer and you get more money later on. I can remember one situation many, many decades ago, it must have been in the early 80s, I think, where there was an offer for a company called Roundtree's. Some English people may know the sweet, there's Roundtree's gums. So when this offer was made for Roundtree's gums, there was first an offer, I forget who it was from. I think one was from Cadbury Schweppes, the other one was from Nestle. Maybe the other way around, I can't remember anyway. But long and short, we had two companies bidding, one after the other. The shareholders kept getting these offer letters saying, accept our offer please, and you had to make a decision. Now the best decision in that case was to do nothing until the institutional shareholders said, now the offer has become unconditional and this is the final offer, we directors recommend everybody accept it. So when you're considering a corporate offer for a particular share, to buy the shares out at a premium to the current price, it's worth seeing what the directors actually say. If the directors are saying, refuse the offer, we don't think it's a good deal, then think about it, see what other shareholders are doing, read the press. If the directors say, we think it's a great offer, you should accept it, in all probability, that's the right decision to what the directors say, but it's not always going to be the case. But the advantage of that sort of offer is that if you accept the offer and it goes through, you'll get cash. Now, why is that important? Because what happens if you take no action and you don't accept the offer, but everybody else does? So now the buyer has got 99% of the shares and you've got one. Are you in an advantageous position or a disadvantageous position? Well, the answer is you're in a disadvantageous position. First of all, you probably won't be able to sell your shares because they'll be delisted. And secondly, you'll have very little recourse if you don't agree with what the company's doing, because you're the sole shareholder. They've got 99% of the other shares, and they can decide whatever they like. And probably what's going to happen, after a period of time, they'll do a buyout, they'll go to the courts, get a court order, which basically says that anybody who's not accepted the offer, that's called the holdout shareholders, are bought in compulsorily and typically at the offer price. So you're unlikely to make more money by being a holdout shareholder. So those are the type of investments offer letters you get where you've got to pay attention and take some action. It's no good hanging on until you'll find you're suddenly the only independent shareholder in the company. because sooner or later they're just going to buy you out at the same price as you could have had a year or 6 months earlier. Another type of corporate action you might get is where a company is conducting a buyback, and in doing this, this would be typically a company which has got some surplus cash, and they are offering you the option to sell your shares, typically at a higher price than the market price, to them. But the offer is limited to a certain percentage of your shares, or a certain percentage of your shares plus an extra percentage if some shareholders don't accept it. Now, those type of letters are definitely worth looking at, because usually the offer is to buy some of your shares at a price which is higher than the market price. Now, there's an argument that after the offer is completed, the market price might have gone up above their offer price, but on the day they're making the offer, typically it's a higher price, which isn't a bad deal. So it depends how much higher. If it's only a few percent higher, it's probably not a great deal to look at. But if, on the other hand, the percentage difference is large, you definitely want to look at it and take up the offer. So I'll give you, I won't say the name of the company, but there's an offer going on at the moment. I've just received the notice in the post today. It didn't come in the post, actually, it came electronically, but same thing. It's a UK investment trust which is trading at a huge discount to the net asset value. The net asset value is around 21 pence, it's slightly over 21 pence, and the share price is around 14 pence. And the company has written to me and said, we're offering to buy back your shares with a minimum purchase for you if you wish to proceed of, I think it's 21% of my shares, at a price of 21p, but you don't have to accept it, and if you don't accept it, you'll still continue with your old shareholding. And also, if some other shareholders don't accept the offer at 21p to buy your shares, you'll be able to have an increased percentage of shares, and it will be more than the 21% that is guaranteed as a minimum purchase. So, to my mind, that's a very good deal if I accept, and a very bad deal for me if I don't accept. Because if I do nothing, I'll end up with exactly the same shareholding as I have at the moment at 14p a share. And if I do accept, I will end up with a slightly smaller shareholding, but I'll have received in cash 21p for every share they've purchased. And then I could use that 21p, I could use 14p of that 21p per share to buy myself another share, and the extra 7p I could use as well to buy more shares. So effectively, I'm getting on 21% of the company, which they're offering as a minimum, I'm getting a premium of 50% higher than the current share price. Current share price 14p, the offer is slightly more than 21p, so it's definitely worth it to accept that offer. And what I'm hoping is that some shareholders, as often happens, I mean, it always happens, some shareholders will just ignore the offer and sleepily just go to sleep on it, and that means that probably more than, I would say not probably, definitely more than 21% of my shares will be bought at this high offer price of 21p a share, giving me perhaps, I don't know, we don't know, but certainly a little bit more than 21, perhaps 23%, 25%, maybe if I'm really lucky 50%, but I don't think it'll go as far as that. But that would be really great to get a whole bunch of my shares bought at a huge premium to the market. So when you get those sort of offers, called share buybacks offers, now obviously some companies just do the share buyback in the market at the market price, and you don't have anything to decide at all, so there's no letter to you. But others do it by way of an offer letter to the shareholders saying, hey guys, we've got a lot of cash, we're going to redistribute to our shareholders. Those who want to accept the offer, tender your shares to us, and whatever happens, if you tender your shares, you'll get a minimum 21%, and or whatever the percentage will be. And if some shareholders don't accept, you will get a larger or you will be able to apply for a larger percentage of your shares being sold at the tender price. So that's what, when you see these tender offers, look at them very carefully to see what percentage of shares will be sold at the tender offer. Sometimes it'll be tiny, it's not worth a biscuit. Sometimes it'll be large, like in this particular case, where it's absolutely worth having a good look and taking a decision to do it. So that's all about corporate actions. There are probably some other forms of corporate action. So, as I said, 99.9% of the corporate actions that you hear about or see, there's no action required. But there are a few where there is an advantage in reading the text and seeing if it's worth the trouble. And in some cases, if you don't own the shares, it's probably worth looking if there's an arbitrage opportunity to buy the shares, if you've still got time to accept the corporate action and you know it's coming. Now, this particular one that's happening today, you can't now go and buy the shares and benefit from the corporate action anymore because it's past the XC date, or whatever they call it, the X date. So it's only available to those who are shareholders as of today. But they did, in their last quarterly report or half-yearly report, annual report, say that they were going to organise this later in the year. So had you read that report, you'd have known it's coming, and you could have bought up a bunch of shares at a fraction of the net asset value, 14p. I think they were at the time, they were about 12p to be honest, versus 21p of net asset value, and just sat on it waiting for this offer to come. So anyway, that's all I've got to say. If you like what I've just said, if you like this type of video teaching about stocks, stock markets, and concepts in the stock markets, and hopefully you'll learn a few things and make less mistakes, then you can like, subscribe, and if you've got any comments, put your comments below the video and I'll be happy to answer them, at least for the next 7 days, which I'll be monitoring it. And also if you want to get in touch with me, you can write to me on LinkedIn, and that's the only place you can communicate with me apart from underneath the video itself. On LinkedIn, I'll be happy to reply to any questions, comments, or general observations you've got. Thanks very much, everybody. My name is Clive Thompson, signing out and wishing you a lovely week and so on. Bye, everybody.